So hi, I'm Josh. I know a lot of you. I don't know a lot of others of you, so say hi afterward. I am not an investor in Bitcoin, so full disclosure. I primarily invest in my children's teeth, so I'm hoping that pans out for me at some point here in the future. So I digress. We're not here to talk about volatile and speculative investments. We're here to talk about Bitcoin. Yeah, let the irony sink in there. Okay. Clicker. Yeah, so like Joe said, I'm Josh. I'm a senior software engineer here at Skookum. Here's a list of some clients that I've worked with in the past. You may recognize some of these names. So these are some people I've done some work for here and other places. Let's see. So like I said, sorry, I'm trying to manage from 2 points here, so bear with me for a moment. We're not here to talk about Bitcoin. So if you're here to talk about Bitcoin, the exit's that way, right? So I'll wait while most of you leave. No, in reality, we are going to talk a little bit about Bitcoin today, but only insofar as it's useful to the blockchain itself, right? So I'm excited and intrigued by blockchain and by Bitcoin just like everybody else is, but I feel like Bitcoin is a means to an end, right? If you're not participating in the network and in the economy, then you're just speculatively buying money. I woke up this morning with the knowledge that I was giving this talk today. Oh no. And so I Googled blockchain this morning, right? There's a lot of results. There's a lot of things out there. There's a lot of information. There's a lot of misinformation. So I'm hopefully going to help clear that up a little bit today and help you understand what blockchain is, what Bitcoin is, and how it's useful. So it's often conflated, right? People talk about the two interchangeably, blockchain and Bitcoin being used in the same context, right? They're very much not the same thing, and I just learned that this morning. Okay. What blockchain actually is a new application of existing technology, right? It's distributed technology, distributed commerce, distributed computing. So anybody remember Napster or BitTorrent or Tor or any of those other things? If you've used Airbnb or taken a vacation with Airbnb, if you've supported someone on Kickstarter, or if you bought something on Craigslist, which is the platform for direct peer-to-peer exchange of used treadmills, then you have used something similar to blockchain in the past, right? So there's all forms of distributed commerce, though most of these are actually brokered by a single authority or a single company, right? So Napster was a wholly owned company. They were, I don't know, not making money apparently, which is why they failed. But several of these are backed by a company, which is very different from the blockchain. So that's what's different about blockchain, a lack of centralization. And that's one of its real strong points, is that it's not a centralized network, right? No one owns it. Ethereum, blockchain, many of the different things, they're just collections of users that have a common goal of doing business in a certain way. So blockchain's a peer-to-peer network. It's been around for a long time. There's many examples that we use every day. So there's DNS, right? How many people got super excited about DNS and were like investing in the currency of DNS and all of that sort of thing? Nobody? It's the same thing, right? It's a distributed technology, arguably as transformative as blockchain. There's just no money attached to it, right? And this is America, and we're capitalists, and money is the closest thing you can get to God without being religion, right? So we have a new thing, and it involves money, so we're super excited about it. So in fact, the internet itself is actually a peer-to-peer network, right? So it's different nodes on the network. Different people can be publishers and consumers of content. You don't have to pay anyone necessarily to be involved in that. So it's the same paradigm as the blockchain. So blockchain's product is decentralized, anonymous storage with tamper-resistant features. Those things leverage the computing power of all of the participants. So you may have heard of that before as being distributed technology or distributed computing or utility computing. So that's essentially what happens. When you're a participant in the blockchain, your computer is being used to process resources, to store data, to store fragments of data that are anonymous and encrypted that other people can't see. I like to think of networks like blockchain and Ethereum as like a virtual farmer's market, right? Or a flea market. So rather than selling produce or handmade jam or refinished tables or something like that, you're selling data or services, right? So it is a marketplace. Anybody can publish services that leverage the blockchain. And those services can be consumed or leveraged by anybody that participates for a nominal fee. And that's where Bitcoin comes into play, right? Bitcoin is the currency of this network. So you could offer an on-demand service as an example that, say, delivers a short story. So somebody sends a request to your service, you deliver them a story, they pay you in some nominal amount of Bitcoin or other cryptocurrency. So the details of that transaction then get captured and stored in the blockchain, along with a unique code, and you can control the licensing. You can control the content consumption. Through the blockchain, you can say, you can consume the story that I've written only on Mondays from 8 to 5, right? And that transaction, that contract that you've created, can be stored inside of the blockchain. In the virtual marketplace, exchange takes place in a peer-to-peer fashion. There's no middleman processing these transactions, right? So we're taking the bank out of the scenario. I'm directly paying you, okay? So there's no fees associated with it. So instead of dollars, cryptocurrency is the means of exchange. So if we use our short story example, somebody else could create a service that aggregates short stories, right? And then someone could subscribe to that service. They get paid through Bitcoin, and then as they consume the content, you get paid for your content, right? So you can see how you can start to think about a distributed method of exchange throughout that network, right? So when your short story is accessed, you get a microtransaction, right? The microtransaction goes to the aggregator, and then part of the transaction goes to you as well. Why not just use a regular bank, right? I think that's everybody's first question when you start talking about blockchain and a new currency. We already have this, right? We've been using money for a century now, or 2 or 3, a lot of time. I haven't been using it that long. So what most people aren't aware of is that transactions that happen through your bank, they're not exactly fast, right? You deposit a check, it takes a couple of days. It actually takes about 30 days, but nobody really knows that commonly, right? That it takes a long time for that transaction to actually reconcile in the background. So the blockchain can change that, right? Those transactions can happen the same day, within minutes, within seconds, where the bank is taking up to a month in order to transact or to close out that transaction. So they're essentially guaranteeing the completion of a transaction and lending money, right? That's what banks do. They just loan money, and then they use the money that they have on hand to invest in other places, right? We call that a trust network. So you trust that the bank is going to complete this transaction. The bank trusts you that you have the money in order to verify it, and they do that through a lot of means where they know that the money is there. Trust may not be the best word to use in banking. But for this convenience, banks charge us a fee, right? They charge us lots and lots and lots of fees. By some accounts, up to $30 billion a year in transaction fees in our economy, right? The really scary thing is that about 10 billion of that goes to 4 banks, right? That's a lot of money, right? So don't get me wrong, not bashing banks. We do a lot of work with banks. We love banks. They're great for Charlotte, right? They're great for our economy. But that's a staggering amount of money, right? That's a lot of money that could be used in other ways by businesses or by consumers. You could invest in other ways. We could share that money, right? Instead of $30 billion going to a handful of banks, $30 billion could get spread out amongst all of our businesses and be better for all of us, right? So I digress on the banking front. Let's talk about blockchain in more simple terms. Let's say we go to lunch, right? We go to lunch and we pay using our fancy new smartwatch, right? Because at some point in the future, in the very near future, our wearables are going to be used as our point of transaction, right? Rather than pulling out a card, we're going to use our wearable in order to make our transactions. Okay, so our purchase is logged. Move through these quickly. And all of these transactions are stored in a block, right? This is the block in the blockchain, right? So we have one central place, and all these transactions come into it, and they're tracked through these IDs, right? Each transaction has a meaningful code, right? Like a barcode or a serial number that's associated with that block. And that block is a calculation using a hash value. This is a hash table or a hash map, which is not an accurate hash map, so don't try to use that anywhere, right? And we create a unique signature. And that unique signature is comprised of the actual content of the record. So this is a fake transaction, right? So it's comprised of all the information there. It's hashed into a value. So what was transacted, who transacted it, what was the fee, what was the item that you purchased, all of that gets hashed into a value and stored inside this block. Plus, the full hash of the previous record. So this is where blockchain starts to become really cool, right? This is what makes the chain, right? So blockchain is actually meaningful. You have a block of data, and they are chained together because each record contains a reference to the previous record, which is where we start to get tamper resistance, right? If you think about it in the terms of Dre, where are you? Can you say this word? Okay. Nesting dolls, right? So this is the same concept, right? You have something, a transaction or an item, and then it's contained within something else, which is contained within something else, contained within something else. In some ways, the blockchain is sort of like a gobstopper. You guys had a gobstopper before, right? It's layers and layers and layers, right? But it all makes up one thing. So finally, all of these records are closed and sealed using a signature, right? And the signature then defines the entirety of this individual block in the chain, right? This is called proof of work. And there are many different ways to accomplish proof of work. I'm going to talk about one of those ways today. That way is the blockchain that Bitcoin is associated works. There are other networks such as Ethereum and other platforms that do proof of work in different ways. We're going to talk specifically about the one that blockchain uses. So creating the signature is a complex process. This is where the utility computing comes in. So everybody is participating in order to generate this calculation. The unique thing, many different people are involved in it at the same time, right? So everybody is involved in trying to calculate this value in order to close out the block, right? So we run through multiple algorithms to try to find this value. It's a secret value, and it's supposed to be hard to find, right? So we're running calculations against algorithms to try to find this value. And you're actually competing against one another to do that. The winner gets paid in some Bitcoin. They also receive the transaction fee. So if you imagine all the transactions that could potentially be running through the blockchain, if you calculate up 1 million different transactions into your block, and some of those are very high value, and you're going to collect fees on those, you know, there's a lot of money to be made in basically pulling away from that $30 billion of transaction fees that's going to the banking industry, which is why you hear so much about companies investing in Bitcoin mining. So this process is called mining. That's what mining a Bitcoin is competing to calculate this value, to find the signature, to close this block, and receive the reward for it. The process takes approximately 10 minutes, or I think it is a fixed 10 minutes within blockchain to execute. So when the signature value is finally discovered, right, then the miner sends it out to the network to verify. So again, there's a lot of ways that this verification system can happen, but the most common is a lottery system, where one miner is basically assigned with validating that. And then once it's verified, another miner is tasked with verifying it a second time. And this is a simple explanation of how this works. Underlying, there's a lot more complexity that goes in here. I'm trying to just give you a very high level, simple explanation, right? So again, when validated, the miners are rewarded with cryptocurrency or coins. So again, I keep saying we're not going to talk about Bitcoin, and I keep talking about Bitcoin, but this is the use case for Bitcoin, right? It's used as a way to exchange items or to reward miners inside of the blockchain network. This is one of its real world uses, right? So they also collect the transaction fees, as I said. So high value transactions drive up the reward value. So there's some impetus or some desire to go out and mine these coins because you're going to make some reward for doing it. Now the issue here, and a common justified reason for arguments against blockchain, is that this process takes a lot of energy and a lot of computing power. So you see on the news companies saying we're investing in blockchain mining, and they're moving in, you know, lots of computing equipment and generators and backup systems, and they're sucking up all this electricity in order to do this. So this is why a lot of other networks have come up with other ways to do the proof of work, because it is a very energy intensive way of closing out chains, right? It's not that great for the environment, and especially in an age where we are regressing our environmental policies. I digress. So again, there are other systems other than mining coins. So you might hear some people talk about minted coins. So there are some exchanges that rather than having this mining process, they control the flow of currency inside of their network. So we're about to do some work with one such currency. It's a 1-to-1 match to the US dollar. You can control the currency in that way, mint those coins and release them into the economy, much like the US does with our dollar, right? Rather than letting people mine those coins. And that way you can control the economy, you can control the amount of value that's out there, and you can have better control over the value of that currency. So you don't end up with these wild spikes like you see with Bitcoin. All that is to say, once that block is mined, it becomes the last link in the chain, right? So all new blocks from that point forward, use the most recently mined block as their starting point. Because remember, they're all nested within one another. You've heard of forking, right? Has anybody heard of forking inside of the blockchain? So what can happen is that multiple people can find a value or a value that matches, right? And I think in most cases, the first one wins, or the one with the most consensus wins. Well, there are often times that the second found version will be forked off into a new fork of the chain, so the chain can actually go off in multiple directions, right? So this is, again, this is the tamper resistance. If we just look at this graphic, which is not what the blockchain actually looks like, you can see where, or if you think about those, what was it again, Matryoshka dolls? Okay, thank you. That's exactly what I said. You know, if you go and alter one of those, right, they're tamper resistant. If you go and alter one that's deeply nested down in that set, the next one won't fit, right? And the same sort of thing happens in the blockchain. So if you go and alter a transaction that's already happened, the next transaction in that chain now won't validate because it uses a hashed value of that previous record to do its validation, right? So if you tamper with one, basically you have to tamper with the entirety of history in order to make changes to that record. So immediately you can see a lot of use cases in, say, government data, right? Where you want a record to remain consistent forever. You don't want that to change. So you know if that record has been tampered with, right? Okay. Now we know what blockchain is, more or less. So what can we do with it? So there's lots of things. So there's a lot of buzz and hype around crypto trading. Everybody's excited about the currency, but the currency, again, it's just the units of exchange within a network. So what's interesting to me about blockchain isn't the currency itself, it's the possibility of the network, right? And that's where the value of Bitcoin really should be derived, right? The potential of the network, or the value of any currency inside of an economy should be derived. It's by the potential of that economy to empower the business world. So as it stands now, people are investing real money in an economy that they have no interest in actually participating in any way, shape, or form, right? Is that a smart investment strategy? I don't know, I'm not an investor, right? So it could be interpreted as excitement over the network, right? All these people buying up Bitcoin, they could just be really jazzed about the ability to, you know, store records in the blockchain. Probably not. I think it's seen a lot as any other currency, right, to invest in. I think a lot of people are just chasing quick and easy money. But just like Amazon has created a new economy of physical commerce, so blockchain aims to create a new economy of digital commerce, right? Things that happen in the electronic world. So we're going to have emerging markets for marketing data, for health data, for competitive analysis, for artificial intelligence services, financial services. All of these things can exist inside of the blockchain. So it's feasible to expect that entire businesses will run solely inside of the blockchain. That will be the only market that they exist in and play within. You can even build a bank or a credit union inside of the blockchain, which is probably not a really popular stance because the whole goal is to get away from banks, right? But we have to imagine that a $2 trillion industry probably isn't going to just disappear, right? They're going to adapt. They're going to find ways to exist within this marketplace, and they're going to take their business model into crypto markets as well. Right? So you could build a credit institution, a holding, or an investing institution inside of the blockchain. There isn't any reason that you couldn't do that. It sort of defeats some of the initial purposes, but again, these industries aren't going to go away. You have groups of participants that band together and basically form credit unions where you could lend money to one another. You know, could lend cryptocurrency to one another, just like savings and loans or other banks existed in the past, right? Microlending could explode under the blockchain, right? The ability for us to loan small amounts of money to other people in order to start businesses. So we've seen things like Kiva. Is anybody knowledgeable or know about Kiva? It's a microlending platform. You lend money to people in underdeveloped countries who want to start small businesses and help, you know, grow themselves out of poverty, right? So microlending is a great application for the blockchain as well. So there's even going to be opportunities for robo-investors and for everything else that we see happen in the financial world to take place inside of the blockchain. So in a blockchain bank, every account holder would essentially be partially responsible for maintaining the safety and security and distributed nature of their data, right, and the redundancy of that data. So we've heard a lot about data breaches, you know, with Equifax and things like this. This is a way to help prevent massive data breaches, right? We move things into the blockchain. the data is actually just distributed and decentralized. There's not a single place for an attacker to come and look for that information. It's spread out, it's hashed, it's cut into pieces and spread out amongst all of us. So we're all taking an active role in ensuring the security of our data. So of course, no software system is ever fully secure or guaranteed to be free of breaches, but they would definitely decrease, right? It would be much harder to reassemble that information. So by making every account holder available as a node in that blockchain, we could drive down the operating costs of banks, right? They don't need all the large distribution centers. They don't need the data centers. They don't need to hold all of that information. They could maybe even discontinue a couple of fees. Wouldn't that be awesome? Okay. So we're software engineers in Charlotte, a lot of us. We've all worked in banking systems, or we know people who have worked in banking systems, and we hear all about them. We know how banking software is built and managed and deployed. See, the imagery is starting to sink in here. So there's opportunities for improvement everywhere, right? So leveraging these new, more secure technologies, it's in the best interest of everybody, particularly in the financial industry. There's enormous gains to be made through exploring new channels, through using new technology, and a tech reboot would be a great option for a lot of the financial organizations here in town. So what if we're not a bank, right? Mostly we've just talked about how banks can use the blockchain. But blockchain's goal, in a lot of ways, is to reduce the impact of banks or the role of banks in the economy, right? More direct person-to-person transaction, not using a middleman. So how can your business, which is decidedly not a bank, operate inside of the blockchain? So let's imagine that we manage assets like art or music or film. You can control ownership of those, right? So you can grant licenses inside of the blockchain that are stored as single records that are tamper-proof. You can grant people access to that information. You can grant them usage rights. You can tell them when they can use it, in what capacity they can use it, and how it's able to be used. And then you can get paid in real time, like without the bank in the middle, right? So as somebody consumes your piece of content, you can be paid for that content consumption. So let's imagine the film industry embraces blockchain technology. So again, access rights to content can be granted in near real time, and you could sell direct from the marketplace to the consumer. So publishing companies can modernize and streamline their digital delivery mechanisms, and businesses could essentially create content channels where they go out to different content providers, and then they could stream that content directly to you and charge a curation fee. Again, we talked about that with our story example. Content consumers could pay for content at the time of consumption. So directors and writers and actors, camera operators like the gentleman here behind you, and everybody involved in the production could be compensated in real time. So imagine you go pay for a ticket, right? And at the time that you pay for a ticket, a microtransaction goes out to everybody who was involved in creating that production, and they could immediately be compensated for the use. So every time that that piece of content's consumed, you're getting paid. So rather than waiting for royalty checks to show up once a month or once a quarter or once a year, you get paid as that content is consumed. And that could happen everywhere because it's a digital property, right? So it could happen if it happens at the theater, if it runs on TV, maybe even somebody makes a reference to your movie inside of another movie, right? Maybe you get some small royalty payment from that. So at the same time, like the people that write the music or that compose the music or that perform the music, all of those different things, those people could be paid as well every time that soundtrack is played in relationship to that movie. So there's a real marketplace that could exist for that sort of thing. All right, so real-time consumption of metered services are a great use case. So as an example, my son and I play a lot of FIFA on the Xbox. He's a big soccer fan. So imagine if when you played FIFA and you call up, let's say Barcelona, right? And Messi comes on the field. Messi gets a kickback immediately, right? Because his rights are being used, his image is being used in a video game, and immediately he gets compensated for that. So it's another way to build an economy inside of this digital marketplace, right? So likewise, the artists, the developers, the people that wrote the code for that game could be compensated every time it's used. You could eventually get to a model where software or entertainment products are pay-as-you-go, right? So you don't actually even make a transaction to consume that, that initial piece. So you, instead of paying for your FIFA game to put in your Xbox, you simply play that game, and every time you play it, you're being charged some amount of currency for interacting with that, right? And so the blockchain is a great use case for this because it keeps accurate transaction records We know when those things were consumed, and we can immediately send payments out to all the people that were involved in that. And we don't have the wait times. So that licensing infrastructure doesn't exist yet. So there's an entire vertical for businesses to explore inside of the blockchain, creating the technology that would support those sorts of things. So there's a tremendous industry that's out there waiting to be tapped. So there's other industries like shipping and freight and logistics transport, those sorts of things. Like we're moving to autonomous trucks, right? Once we start taking people out of the process, you have trucks moving around from place to place, moving goods and services. All of these things could happen in a more autonomous way using the blockchain to keep track of what load are you picking up, where are you taking it, how many miles did you travel? And then you could actually compensate the people that own the vehicle in real time for every mile that they drive. So those sorts of things happen now, but there's a lot of manual process that goes into calculating those things, submitting logs, making sure that the drivers are legal, that they're driving the hours that they're supposed to do. You could automate that entire process. You could even make shipping be a commodity so that a single truck could move freight for FedEx, for UPS, for individual consumers, for the USPS, everybody at the same time, maximizing the amount of space on that truck, and everybody would be paid, everyone would pay just for the amount of space that they're using and for the mileage that they run, right? And all of that could be facilitated by using the blockchain to store that information. Another great use case is tracking food from farm to table, right? We have really terrible systems for that right now. I know that because I wrote them for a long time, as did this gentleman here to my right. We tried to help environmental health agencies build systems that tracked food from farm to table, and it's really difficult. They pass through a lot of hands, right? So by using blockchain technology, we can store all those transactions. When the food leaves the farm, when the food goes to a food producer, when it gets processed, when it gets shipped out to someone, when it lands in the grocery store, when you pay for it, and then ultimately when you take it home. So imagine a scenario where we have a food recall, right? Right now, it's really difficult to know if that food gets recalled because we found a problem at the source, who actually is consuming the food from that source. Or the other way around. We find that there's bad food in a grocery store and that it's contaminated with E. coli or something like that. Using the blockchain system, you could track that all the way back to the food producer, to the grower, you know, everyone that's handled it along the way. So we can immediately get recalls out to people that would be affected or impacted, and it would create a much better means of transparency for that industry. It also means that things like certification for GMO, sustainability, fair trade, certified organic, cruelty-free, kosher, all of these different labels we have on food, we would be able to more accurately track those things because we actually know all the processes in the hands that food has gone through before it gets to the consumer. There's also great use cases in record preservation and record keeping. I alluded before to government record data. So again, for years, I worked in environmental health space where inspection records, when somebody comes in and inspects a restaurant, for example, that inspection can't be altered going into the future, right? Whatever happened that day is what happened, and you can't alter that record. So anytime that you have data that it's subject to Freedom of Information Act requests, documents that need to remain like contracts that can't be altered, that are just amended later, those are great use cases for a tamper-proof system because you have a record that stays there, that's permanent, that never alters, and then later you can add additional supplemental information to that record, but you have a chain of custody for that data, and you know what happened. There's lots of other great use cases. Scientific data studies, right? So how many times do we hear about studies that happened with a drug company and then we found out later that the results were tampered with in order to get the results that they wanted, right? So real scientific data captured in the blockchain can't be altered, right? It can be reported on, and maybe you can mess with the reports, but you can't actually change the underlying data, right? So private medical records would be a great use case. Municipal deeds, property ownership records, land rights, mineral rights, all sorts of things related to land ownership and land use. There's a virtually unlimited number of other potential markets for blockchain technology. Anytime you have records that you don't want to change, that you want secured, that you want distributed, that you want encrypted, the blockchain is a great place to store that information. So again, I've outlined a handful here. There's a bunch of smart and talented people. Most of them are wearing black shirts with what looks like an Atari logo, but isn't an Atari logo. And they can help you understand how to leverage the blockchain for your business. Another great use, cross-border exchange is cheaper and faster. How many people here do business across international borders? Anybody do that? Anybody have any idea how long it takes for money to move across borders? So the 30 days can become 60 days or 90 days. It takes a long time for transactions to happen across borders. So this is a great use case as well. You can do business across borders in near real time, so money can exchange hands. You don't have to deal with things like currency exchange. If you're using Bitcoin, then you're exchanging a single currency, and instead of converting from the euro to the US dollar to the drachma or whatever Dre is using, you can use the Bitcoin for all of that, right? So I'll say, this is a stretch, digital currencies are the natural evolution of trade, right? It is a very human thing to trade interpersonally in real time. We've been doing it since the time we were passing fire around to one another, right? It's a very natural thing to not have to give that money to someone else who then gives it to the person that you want to give it to and who takes part of it along the way, right? So I talked briefly about wearables. So wearables are another great place that can integrate into blockchain, right? So if we start putting payment mechanisms on our wrists or in our pockets, then we want some accurate representation of how that data is being transacted. It's going to be harder to see that information through the bank. It's going to be slower. Those things are going to take time to come out. So this does raise visions of a sci-fi future where Matt Damon has a bunch of numbers on his arm. Has anybody seen that movie? Right? Yeah, nobody's seen that movie except me. Okay, right. So, so if recent history is any indication, we are headed for a cyberpunk dystopian future. But we can steer this direction ourselves, right? So using the blockchain and keeping better track of this information, we can leverage its capabilities to help us move forward. So again, to improve the state of cybersecurity in all markets, people are going to have to embrace the principles of the blockchain. So decentralization, encryption, anonymity. So regardless of whether or not they're actually using the blockchain, these are things that are going to have to happen in order for us to have a more stable technology future, right? Where we're not being constantly hacked, where our data is not constantly exposed, where we're not constantly having our identity stolen by other people. So blockchain networks are poised to offer us a pathway to realize a safer and more secure future in the online space. So again, speculators are buying in early when currencies remain cheap and hoping to turn a profit. But the best thing for blockchain is for people to participate in it, right? So rather than just buying currency, encourage your organizations or the organizations that you own to build things that exist on the blockchain, right? Help create this economy and help drive it forward. Simply speculating in the currency, while it does drive up the value of that currency, and obviously it raises the awareness, which is why all of you are here today, the real power of the blockchain is in the technology and the solutions that we can build on top of it. So, the question many of you might have come here for is, should I invest in Bitcoin? Right? So, we'll say Charlotte's full of financial advisors, investment professionals, banking experts, and I am none of those things. But my stance on this is, do you plan on participating in the economy? Right? If you don't plan on participating in the economy, maybe it's not the best thing to be investing in, right? If no, and if you are already investing in other technologies or other foreign currencies, right? Maybe that is the thing for you. Maybe you trade other people's money all the time, and that's a good investment for you. If you have that kind of money to play with, I'm happy for you. But why gamble on an economy that you have no stake in, right? So that is really that's my fear about the buzz about Bitcoin, is that people are buying into it. They don't necessarily understand the technology behind it. They don't understand the use cases for it. It's just exciting and everybody else is buying into it. But what that creates is volatility in that market. And what that ultimately will do is destabilize the technology that's underneath, right? So if it's hard to get into, if it's hard to participate in that currency, and if the value of everything is already inflated before the market even exists, you've got an environment where you've created inflation before you actually have products and services, right? So who's going to want to participate in that market? So for the good of blockchain, don't invest in Bitcoin unless you're actually using the blockchain.